Welcome to Market Taker Mentoring's Options Basics. This segment is on planning around volatility. Options involve risk. Prior to buying or selling an option, a person must receive a copy of Characteristics and Risks of Standardized Options. Copies are available from your broker or by calling 888 Options, which is the Options Clearing Corp. Volatility. By definition, volatility is the statistical measure of the dispersion of returns for a stock or market index. To put it in more simple terms, volatility refers to the amount of risk or uncertainty about the size of changes in a stock's value, which is the stock's price. High volatility means that a stock's price can change dramatically over time. And unexpected volatility and sometimes lack of volatility can be detrimental to an option position, depending on what strategy is utilized. What causes volatility? First, there's inflation. And historically, there's an inverse correlation between low inflation and stock valuations, as in volatility. Strength of market and pairs. To give you an example, let's say a stock has a negative outlook. It might drag down another similar stock in the same sector, and sometimes even the whole sector. Psychological issues. Human behavior. Greed can cause a stock to increase more than it should be, maybe, and fear can do the same and impact the stock negatively. Supply and demand. Stocks that trade smaller volumes are sometimes prone to bigger fluctuations, more volatile. Uncertainty. When a stock's future is vague, there tends to be larger price movements on that stock. Traders have apprehension, which causes volatility. The last is economic events. The latest info about a company is critical, and depending on how the market interprets the info, can move the stock higher or lower. So there's kind of two types of economic events. Ones that are unexpected and others that are expected. So unexpected cannot be controlled, like a bankruptcy, or maybe a CEO is stepping down, or there's an unexpected lawsuit out there. Expected is something that we should be able to find out about in advance, that's planned for. Like, let's say we're looking at a pharmaceutical company and we notice that they're going to release the results from a drug trial. You can expect that. I'll give you a date on that. And probably the biggest is the earnings announcement. Now, earnings announcement is when a company reports how profitable it was, usually in the previous quarter, and they sometimes offer guidance about what to expect going forward. So depending on how the market interprets the announcement, it can cause price swings, and some can be quite substantial. So traders need to be aware of any economic events that may be taking place on the company they may have an option position on with already, or are thinking about implementing an option strategy on, especially in earnings announcement. What you need to do as a trader, you need to check any recent news about the company and any possible pending news that may be coming out. And especially check when the company is supposed to announce their earnings report. Here are a couple great sources to use for news and to find out about economic events. Benzinga, Yahoo Earnings, earnings.com, and NASDAQ.com. Now you know what volatility is and why you need to be aware of it.